Now, the International Monetary Fund has advised Nigeria and other developing economies with large foreign currency borrowings and external financing needs to prepare for turbulence in financial markets. In a blog post titled "A Disrupted Global Recovery," the Washington-based agency says such countries such as Nigeria should consider extending their debt maturities as a means to contain foreign exchange fluctuations. In the meantime, the rise in oil prices might have a negative impact on Nigeria's revenues, according to Shubham Chaudhuri, the World Bank's country director for Nigeria. Geopolitical tensions in the Middle East and Europe, combined with tight supply, saw oil touched $90 a barrel on Wednesday, its highest level in 8 years. Chaudhuri explained that it is hard to come up with an exact estimate, but further oil price increase might have a net negative impact on Nigeria's revenues. Ibukun Omeyeni is an economist with Vevita Capital Management, and he joins me now to discuss this further on the line. Thank you, Ibukun. Good morning. Great to see you. Friday. Yeah, let's start with the World Bank warning. If rising crude prices mean more revenues for Nigeria, how then is this a net negative, according to the World Bank director?
Okay, thank you for having me. So we know very well, right, that Nigeria is an oil-producing nation, but unfortunately we do not we don't consume our domestically refined oil. And what that means is that we would have to export, generate revenue, and we'll have to import the refined product at a higher price. So that's where the net negative return comes in. So with oil prices rising to $90 per barrel, naturally we should see more oil revenue. But again, the landing cost of PMS, it will now be higher, and that means more subsidy expenditure for the federal government. And what that amounts to is there's going to be a large fiscal deficit. The current situation with Nigeria, again, is that oil production has been reducing. So when you have oil production reducing, prices increasing, we may not really maximize the impact of higher oil prices. So coupled with low production and with the high subsidy cost, is actually a net negative for Nigeria.
The World Bank claims that 2.5 trillion naira or 3 trillion naira can be put to better, more productive use than energy subsidies. Do you agree?
Of course, really, of course. Subsidies in conventional economics, right, is given to producers in order to incentivize them to produce more. But in this case, we are subsidizing a product that we don't even produce domestically. And what that means is you're actually subsidizing imports, right? And what that means is that there's going to be pressure on your foreign exchange reserves. So definitely the World Bank is very right. And what that does is that the fiscal deficit might rise by at least 1.5 trillion. Because we recall that in the initial budget outlay, the federal government had planned that subsidies would be catered for up till about June. But looking at the fact that because of the electoral season, it's going to take a full year out. So that means subsidies would actually rise, and that would raise our fiscal deficits to levels that have never been seen before. So the World Bank is very right with those statements, and multilateral institutions will actually be very worried, considering the fact that Nigeria's fiscal deficit has been rising. Oil revenue over the years is quite sticky. It has not really risen. It's quite flat, but expenditure has actually been rising. So it's actually a big worry for Nigeria's fiscal space.
Well, the argument, my friend, is that if you remove fuel subsidy, there's an immediate pass-through impact on the average Nigerian in terms of prices of food, transportation, and all of that. So, but if the money for subsidies were to be diverted elsewhere, do you think the impact will be felt immediately?
Definitely not, because if you are removing subsidies, that means you are going to spend on public infrastructure. That means you're going to probably spend on your rail infrastructure, your road infrastructure, and that actually takes time. Of course, it's going to have a multiplier effect in the long run, but in the short, there will be pain, right? There will be pain such that consumers might not really see the impact in the near term. It's over a period of time. That's when we start to see infrastructure coming into place, and that can actually boost transport in the system, right? And I think that's just the way to look at it. Once you remove subsidies, inflation will rise significantly. Over time, it's going to moderate, and prices will adjust to the new normal.
Ibukun, do you think we need to take a bit of a short-term pain, as it were, when it comes to fuel subsidy? Do you think it's something Nigerians should generally prepare for?
Okay, well, there's a good news, right, on the rise, and that's the Dangote refinery. Dangote refinery will be the largest in Africa, and once that refinery takes off, we could even allow higher fuel prices, but that will reduce pressure on our external reserves. And mind you, don't forget that the reason why a lot of people are agitating for the retention of fuel subsidies is because consumers are faced with multiple challenges from multiple fronts, right? You are faced with the depreciation of the naira. You're also faced with higher fuel prices. When a situation whereby a local refiner is absorbing your refined oil demand, they could even increase the price of fuel, but there will be an appreciation in the exchange rate, right? Since the refinery can cater for the nation. So that is where we will see a positive pass-through, right? But if the refinery is not yet on board, then the pain will actually be significant. And we might just need to wait and see how the refinery could help to actually suppress this pain. But again, it's a pain that we'll still have to feel sooner or later.
Well, the IMF, if we switch gear, the IMF is warning emerging markets to fasten their seatbelts, talking about financial turbulence just ahead. Is it all about the U.S. Fed raising interest rates or what?
Definitely. Even according to the IMF, right, there's no central bank in the world that affects the global market, unlike the U.S. Fed. So whenever the U.S. Fed decides to taper, that is to reduce asset purchases or decides to increase interest rates, what you would see is a lot of investors become risk-off. They start selling off their EM assets, EM investment, and come over to the U.S. To invest in the fixed income instruments in the U.S. And what that does is that there will be a devaluation or depreciation in currencies, and those countries will have to respond by raising interest rates in order to attract foreign portfolio investment. So it's very true that we are already seeing that volatility across several markets already, and a lot of banks have started to respond by raising interest rates.
Well, but do you think the new Eurobonds are off the table for emerging markets and frontier markets if rates rise this year? Anticipated definitely looks like, unless anything else changes, March is the liftoff for the Fed.
Definitely, this would be a wrong time to raise Eurobonds because you're going to be raising it at a more expensive rate. And if you recall, last year when we raised that $4 billion Eurobond as a country, it was actually advised. It was actually a very good move because then rates were a bit, rates were a bit low compared to what we have now. The U.S. Treasury yield is rising to levels we've not seen in a while, and of course, this would be a bad time to raise Eurobonds, and for those that want to refinance their loans to come at a higher interest rate. So I think a lot of countries want to stay off Eurobonds for now. And those that are dependent on Eurobonds, they may actually have a negative or a downgrade in their credit rating.
So the IMF is suggesting that emerging markets will lack foreign exchange debt, extend their debt maturities as a means to contain foreign exchange fluctuations. How feasible is this? I'm sure we have quite a number of countries on the continent, Angola, Nigeria, and a few others, such as Zambia. Okay,
extending debt maturities, it has its own cost, right? When you extend your debt maturity, you would, although you have postponed the major payment till a future date, but you're still going to incur more interest costs, and there's actually a cost to it actually. And don't forget, the fixed income market never forgets, right? It's going to be priced into your next issuance. So you don't want to do something that would cause the market to go against your economy. And of course, credit ratings will also reflect any such move. But if we could see probably the debt service suspension initiative come along again, we could see some relaxation around that end. That could help to cater for the pressure.
Economist at Ibukun Omeyeni, thank you so much at Vevita Capital Management. Thank you so much. To have a great weekend.